Happy Wednesday, everybody. And as usual, we are here today to talk about the real estate and mortgage market questions. Quick update while we're waiting for David Gazarian from the IQ Mortgage to join us. We're still in the low market inventory. So as of last week, we had 715 new listings coming onto the market, and we have 982 listings going under the contract. So it tells you that we are absorbing higher amount of properties than what is available on the market. That's why if you're a seller and thinking of selling, go ahead and push that button. Actually, go ahead and list your property. And if you are a buyer, you need to become really prepared and a little bit more aggressive with your purchasing and all the actions. Let's see if David is ready to join us. There you go.
Good morning,
sir.
Alexandra. How are you?
Great. How are you?
I'm doing okay. Thank you.
Eventful morning for you.
Okay. Don't even go there. Yeah. What are we talking about?
Well, as promised, today we're actually giving the layout for all of our self-employed people or 1099 people on how to be prepared for a loan application, which could be a mortgage application or a loan application of any kind. But I would like for you, as the former tax professional and the mortgage broker, first of all, let's define who are considered self-employed people. Like, are these the people that work like for themselves? Are these the people that work under the EIN number? Give us the idea who is considered self-employed and who actually is giving this this consideration. We're talking about IRS. We're talking about like tax returns. Like, where does the word self-employed come from?
Okay. Self-employed means you work for yourself. And this is very important to understand. When I call someone, when I'm, consulting someone in this very conference room, and I'll tell them, you're self-employed, you're a business owner. They're like, David, I'm not a business owner. I'm an Uber driver. It's important to understand that the definition comes from the IRS, the Internal Revenue Service. And for them, you're either an employee, which gets a W-2, or a business. That's it. There is no third kind. It does not exist. You're either an employee that gets a W-2, gets his taxes withheld from his pay stubs, pays the Social Security, Medicare, the FICA, plus your three kinds of taxes, the federal income tax, Social Security, Medicare. You are a W-2. Or you're 1099 contractor. If you're a 1099 contractor, you're a business. There is no difference between you as a sole entrepreneur driving Uber or that huge $2 billion Bellagio building. You are classified a business, period.
Even if you work under your Social Security number. So guys, if you don't have an LLC established, if you don't have an EIN, it doesn't matter. Like, you're still considered a business, correct?
That's correct. The EIN is a good thing to have, where you don't have to keep giving out your social. I would think that you would protect your social at all costs from giving it out, but you getting an EIN does not determine you becoming a self-employed. If you do not work for anyone, then you're a business, or independent contractor is the same business. You're a business. You're self-employed. You're a business.
There you go. So for everyone to be, to have like more clear understanding, if you're not getting a W-2, you're most likely, and you're still working, you're most likely self-employed. If you need to verify it, you can easily verify it with the IRS website and see the definition of the employee. and see the definition of the self-employed person.
I could give you the definition of the employee. My team here, they are what's called employee. I can pay them with a 1099 as much as I would like to, which means if they go to a certain location to work, if they have a specific location and schedule to work, and they get direct supervision. My team comes to a specific location, they have time to work, and they get direct supervision from me. They're W-2 employees. I have to pay half of their FICA. Now, what's different, unfortunately, from you guys, realtors, you're not considered having to go to a certain place of work. Okay, the real estate agents, they can work from anywhere because they show houses, they're outside, and you guys do not get supervision. So real estate agents are true independent contractors, whereas us loan officers are not, unfortunately.
Great. So we figured that out. And today we're talking and giving the information, giving the tips and bits on how to prepare for the loan applications for those who are actually work for themselves. It is a little bit easier with the employees, but when you are self-employed and when you are, you're given the courtesy of figuring out what your own expenses are and figure kind of like you have the ability to kind of manage your personal income in terms of how much stuff you're going to write off and how much taxes you're going to pay back to the government. This is where it becomes a little bit more interesting and tricky because it is a normal human desire to pay less taxes. But once you do that, you actually can deprive yourself of a lot of abilities as far as the loan applications go and your borrowing ability. And that's why today we have David explaining us some stuff, and let's jump right into it with the most important things that number one, the most important thing that all the self-employed people should know.
Let me speak as a loan officer. I could talk as a previous tax person that I used to prepare several thousand taxes, and I know the subject well. I'll talk about it, but you and I are speaking in terms of real estate and mortgages, and the most important thing to understand, and I'm going to put you on the spot, unfortunately, I'm sorry, even realtors, even you have made this mistake. David, I made so much money, and I'm not going to give the number because when you are interested in a mortgage, we don't look at gross, we look at net. Okay, you could grow so much money, huge sums of money, but if I take out your expenses, okay, payroll for your team, Alexandra, you've got a building, all those things we take out, net income is what matters. Okay, so this is what most people leave out. If you're applying for a mortgage, let's define a mortgage. There's two kinds of mortgages. We've got conventional FHA, VA. These are full government guaranteed, full documentation loans. Full documentation means your credit income assets will be verified. When we say a mortgage, we're talking about verifying your income. Income will be verified with your net income after expenses. If you're a sole proprietor, Schedule C filer, line 31. At the bottom of your Schedule C is what you need to look at. Line 31 is your net income. You could gross $1 million for a light care on line 1, gross earnings, I believe it says, gross revenue. Line 31 is what matters because between line 1 and line 31 is where all your expenses are, where your creative tax people literally kill your income and then the loan officer says you cannot qualify for a mortgage.
So one more time to reiterate. For those of us who are self-employed, the most important number when applying for a loan is going to be our net income,
yes,
line
ma'am.
31.
Line 31, if you're a sole proprietor, first thing I ask people, well, that's going to be confusing. Am I a sole proprietor? Do you file a separate tax return, corporate tax return? If you don't, if you only file one personal tax return, then Schedule C is attached to your personal taxes. Okay, Schedule C is the sole proprietorship form. It's 2 pages long. It says, Schedule C, sole proprietorship on top. And yes, on that first page, line 31 is where you should look at.
When you file your tax returns in April or in October, correct?
You As an
if you're a sole
individual,
proprietor.
as an individual taxpayer, your tax date is April 15th to April 17th. Used to be April 15th for forever, and in this past decade, they've been moving around to 17th and 18th. But you can get a 6-month extension for free, and if it's April 18th, then plus 6 months, it'll be October 18th, your last date to file personal taxes. If you're a corporation, which means you file a separate return from your personal, your due date is going to be March 15th. Why? Because you need to do your corporate taxes, figure out how much money you made, and that money is flowing to your personal. That's why the due date for that is March 15th, March 18th. It's exactly a month before the personal due date. The IRS forces you to do your business taxes before. So to give you that 1 month period between March 15 and April 15, so you do your business taxes so you can file your personal taxes.
So and I'm going to talk to you as a 5th grader. If I have an LLC, does it mean that I'm filing a corporate return, tax return, if I establish an LLC?
Let's talk about it. LLC is what's called a disregarded entity. If you're a single member LLC, you file it on Schedule C by default. If you're a 2 or more people LLC, you file it on 1065 partnership return by default. This is default if you don't make any special elections, okay? So the thing to ask your viewers is, if you have an LLC, are you the only person on it? If you're not, you're 1065 partnership. If you are the only person, your LLC is considered a disregarded entity. It will go on your Schedule C with your 1040. There is no separate tax return that needs to be paid.
Okay. So it doesn't make me a corporation. Do I understand it correctly? It doesn't make me a separate corporation if I have the LLC established. There is an extra step to it, correct?
Yes.
Like how do I become a separate corporation, and what is the benefit of being considered a separate corporation if I'm a self-employed individual?
One thing to understand is when you're Schedule C, when you're a sole proprietor, then you are considered the employee and the employer in one person. Your taxes are 15%. I have rarely seen anyone show large income on Schedule C just because the bracket is so high. It is so expensive with Schedule C to show any large income. Most people just kill it. Most people go to some creative tax person.
Can you break down, like, what, when you say Schedule C, what does Schedule C contain and where it goes, and why the large numbers actually kill us on taxes?
Yeah, I was going to. So when you're, before you understand what Schedule C is, you need to know that when you're a W-2, most people have held a job at some point in their life. So W-2 would be an employee, which means your employer withholds federal income tax, Social Security, Medicare from your taxes. Social Security, Medicare are roughly about 7.5% of your earnings. Your employer matches this. So there's 15% going to the IRS, only 7.5 comes out of your pocket. The other 7.5 goes from your employer's pocket. Now, if you're a contractor, the whole 15% comes out of your pocket. You're the employee and the employer. Does that make sense? So we're not talking federal income tax. Just for FICA alone, which is called self-employment tax, self-employment tax is 15%. In case of a $100,000 net income, that would be $15,000 plus federal income tax. So again, Schedule C is expensive. There are better ways to do taxes. It's just sometimes it annoys me how some tax preparers are, in my opinion, lazy and don't do the full consultation to clients. They listen. You need to elect to become an S corporation. That's going to cost you an extra $1,000 a year, give or take, but it'll save you several $1,000s per year. And to give you an example, a couple of days ago, I had this gentleman at my office. His income was north of $150,000 net income on line 31 of Schedule C. North of $150,000. He had paid $42,000 in taxes. This is just. I sat down on a piece of paper. I said, listen, here's what you did, side by side. Had you had an LLC made an S corporation, okay, and we're going to talk about S corporations, you would have saved $21,000. Instead of paying $42,000, you would have paid $21,000.
This is the exact case when making a choice into being an S corp and paying an extra $1,000 a year.
Yes.
For being an S corp actually makes perfect financial sense. So, David, one more time, can you tell me? So, the Schedule C for the self-employed people. This is the IRS form that contains the actual income number that is going to be subject to this 15% self-employment tax.
Line 31, your net income at the very bottom, correct?
Okay, perfect.
Yeah.
So just remember, when you talk to me about taxes, I'm the 5th grader.
Be my pleasure.
So we established that if you are self-employed, then you have two choices: either to file with the Schedule C and pay the self-employment tax, or become an S corporation and save on taxes. So, David, I need to know two things. How do you become an S corporation, first of all? And second of all, how does the system work? So who's going to pay those Social Security taxes? Like, why you out of a sudden stop paying the Social Security tax if you were
Great question. Great question. Then this is important for loan officers to know, for realtors to know. We need to know more than our competition, right? So here's what an S corporation is. Okay, S corporation takes your full income, breaks it down into two uneven parts of different classes of income. One is active, other is passive. It's important to understand with an active income, you pay Social Security, Medicare. When you have an S corporation, you must give yourself a W-2. You may own 100% of that LLC. You're the full shareholder of that LLC. You still work for it. You could be the janitor-in-chief for all I care, but you need to work for it, and it needs to give you a payroll, a certain amount. What that amount is, the IRS defines it fair and reasonable compensation. It has to be fair of whatever your services are for that entity's viability. So if you're making $1 million in that corporation, you cannot give yourself $1,000, okay? So you need to give yourself a fair and reasonable compensation for your services that you provide to that corporation. But that's the other part that you don't give yourself a W-2 for, gets distributed to you through a form which is called K-1, and the K-1 does not contain FICA tax. It is passive income. You do not pay Social Security, Medicare for passive income. Passive income is rental properties. You don't pay Social Security, Medicare for rental properties. What you do pay for passive income, rental properties, or K-1 in this case, is ordinary income tax, just regular federal income tax.
And in the state of Nevada, guys, one more time for all of you who are watching us in live or in recording, we're here located in the state of Nevada, and we are fortunate not to pay the state income tax. Yes. We're only paying federal taxes.
Yes.
This is for those who's not aware that Nevada does not have a state income tax. And so that's why we're not going to go deep and apply anything on what we say into the in regards to the state tax. So, David, as you said, if you are an S corporation, you have to give yourself a W-2. Like, do you have? Yes, Gordon. That's the difference between Nevada and Arizona. We're not sure what the state tax in Arizona is, but if anybody wants to feel lucky about not having a state tax or having a lower state tax, you can always compare yourself to California and New York.
There's only 7 states that don't have state income tax. That would be Washington, Nevada, Texas, Florida. I don't remember the other 3, but the other 3.
Alaska.
They're not important to me, but those states are to me, because I'm going to have a presence. I have a presence in Washington. I will have a presence in Miami, and those are the cool states then, and they have no state tax. So that's important to know.
Excellent. So for the S corporations, when you're saying you have to give yourself a W-9, do you actually have to issue yourself a W-9, or do you just assign yourself some kind of salary and it becomes the subject to the self-employment tax?
Can you repeat that again?
You said that when you're an S corporation,
Uh-huh.
you as an owner, you must issue for yourself a W-2. I'm sorry, I think
That's correct.
I said it wrong. Yes,
Payroll.
you
Yes,
have
you're
to
right.
issue.
W-2.
Yeah. So do you actually have
You
to
must.
issue the W-2, or
You must. If you
and
want to be
that becomes the subject to the tax,
Yes,
correct?
ma'am.
To a
So,
self-employment tax.
yeah. So, what I tell my clients is, if your business is starting, give yourself a relatively smaller um, payroll, but you increase that as your income increases. And if you're running a decent business, your income's going to increase. Increase the portion of taxes that you pay to the IRS. Stay legal, stay compliant. Make sure that you don't do anything stupid, that the IRS doesn't come after you. Okay, this is such a privilege. S corporation is a privilege. You have to be a citizen. Okay, you have to have less than 100 shareholders. So it's a very limited structure that gives you such a good taxation structure. You save thousands and thousands of taxes. So if you're going to take advantage of this and pay less taxes, or with the same amount of tax, show a much larger income, then stay legal, stay compliant, listen to your CPA, give yourself a W-2, increase that payroll tax to the IRS every year, and you'll be happy. You'll be able to acquire houses, get business loans. In my case, lots of my clients are truckers, so they acquire a bunch of trucks. And business, once you have verifiable income, your decisions, your life changes versus someone that just kills their income because the tax bracket is high with Schedule C, because their tax person was lazy enough, did not explain the benefits of an S corporation. They don't even know this exists, and a decade goes by, they don't own a house, they don't have a business, and the only reason for that is they just wanted to save on taxes.
And I want to remind for everybody who is watching here in live or recording, we're not tax advisors, we're not financial advisors.
Not anymore.
All information that we present here, we present here for the information purposes only, and for the purposes of making the process of applying for a mortgage easier for the individuals who are considered self-employed. So, David, when we we just talked about income. So we talked about what kind of structures the self-employed people are supposed to have in order to maximize their benefit of paying lower taxes. Now, can you please tell me about the income and assets? When it comes to paying the bills from different accounts, how are you supposed to do how are you supposed to handle your accounting or handle your financials when you're self-employed? If it's only me, I'm the only one working, I'm the only one spending, so should I just have one bank account? Should I have two bank accounts? Should my business have a separate bank account? How it is going to influence my further ability to apply for a loan if I just turn my financials into a mess?
Well, okay. Let's not forget, I'm in the function of a loan officer in this conversation. I'm not a tax preparer. I haven't done taxes in 8 years. But the one thing I'll tell you is, if you have a separate entity, which is an LLC or a corporation, that's separate from you. That's a separate legal entity. It has its own tax ID, has its own bank account. All your income goes there. Do not commingle your personal income with that income. If you ever get sued, and again, limited liability company, LLC stands for limited liability company, that limits your liability. If you ever get sued, first thing that the suing party lawyer will be looking for is if you have commingled your funds, if you have used your business account as a personal account. So do not buy Victoria's Secret lingerie for your secret girlfriend I'm telling you this because this has happened. My client has done this like 15 years ago. So his wife wouldn't find out it was on his business accounts. Don't do that. Do not commingle business accounts with personal accounts. Only business expenses, strictly business expenses, come out of your business account. If you have a need to take your family out to a restaurant or do grocery shopping, which is a personal expense, you transfer money from business to personal, and only then you take a distribution, you take a K1 distribution, and you spend from your personal checking account. It is convenient to have both accounts in one with one bank where you see both business and personal. You can make a very quick transfer, and that way you never have to commingle. I don't even have my business debit card with me in my wallet. It's not needed. It doesn't need to be with me because I don't spend it. So that's the advice. But again, talk to your CPA, find yourself a decent CPA. There's a bunch in town. There's a lot of good tax professionals in town. Get your affairs in order. The beauty of this thing, Alexandra, is you only have to do this once. Get yourself LLC once. Get your S corporation elected once. Open a tax ID. Get a business bank account. Get this thing done once, and you're done. It's so simple.
As a consumer and a business owner myself, I can tell you that I do feel the benefit of having a business and business accounts, like as far as the debit cards and credit cards. Let's say I have the credit cards that are the business credit cards. So when the lender is going to pull my credit, they're not going to see the balances on my credit cards that are under the business name. So everything that is like all of your debt that is recorded on your Social Security, under your Social Security, this is something that the lender is going to see. Do you see anything that is recorded under the EIN?
No. So whatever debt you have acquired under your business is your business's liability, not your personal liability. As loan officers, we care about your liability. You as the person are applying for this loan, for this debt. So if it's not on your credit, we don't see, and we frankly don't care for, because if you have a business credit card, a business line of credit, that is your business's liability. It's going to be on your taxes, in your bookkeeping, in your accounting, in your taxes. So it's all accounted for. We don't have to worry about it. It's not our concern.
Excellent. So if I need to have a vehicle, like any realtor needs to have a vehicle for work, and obviously we have different ways how to write off our vehicle expenses. But the most important thing that I would like for you to talk on an example of a vehicle. So if your business expense is a vehicle, and let's say you financed it, and this car loan is on your personal credit. So what is the benefit of paying for it or making a payment from your business account?
When any liability is paid by your business for 12 months or more, the 12 is a magic number, cannot be 11, 12 months or more, the two things need to happen. They need to come out of your business account. They need to be shown on your business taxes. I would even say make sure your CPA is accurate to say Mercedes, blah, 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 like even the model, okay? If you could be that specific to show the underwriter that this specific liability that's on your credit report is the business's liability, we can go ahead and ignore it. What's called contingent liability. We can ignore a debt on your credit report, increase your probability of getting a larger loan amount as long as someone else has paid for that debt, meaning it has been paid by your business for more than 12 months and your CPA has done a clean enough job and reported that debt, the model of that car and everything. It's verifiable on your taxes. So two things need to happen. My car's always has gotten paid from the business account, and this is a great advice, in my opinion, to every self-employed person. Doesn't matter whether you're a realtor or an Uber driver. I would tell everyone, every single person, realtor, Uber driver, get yourself an S corporation, pay your vehicles and any other debt that you have from your business account, and once the 12 month payments have been done, your loan officer will be able to ignore that from your liabilities.
So for those folks who have just started their own business, let's say they don't have a business credit card account, but can they actually have a credit card that is under their personal name but is used strictly for business purposes and pay for it for a business? Would it be considered the same? Would the same rule be applied to the payment of the credit card if it's 12 months?
I've never done one before, so I'm not going to tell you. That's not being addressed in the underwriting. I would say the underwriter would push me back on that, so I would get fair amount of pushback from the underwriter for that. I could give it a try, but I don't. It just looks a little fishy. You know, it's your personal credit card. How do I know whether I see Walmart and Amazon, I don't know if it's business expenses, personal expenses. I wouldn't do that. Get yourself a business credit card, give them your tax ID, and that credit card will not be reported to your credit. Just keep it clean. And it's important to learn some basic financial hygiene and stick to it. Your life will be so easy.
By the way, David, does it cost a consumer anything to obtain an EIN number?
No. That you could do that by going to iQRate.
It does not cost anything. It is the 2-page document that you need to fill out and apply.
You could do it online. You can apply the irs.gov. It doesn't cost you to have a social. It doesn't cost you to have an EIN. It's just it's the social security number for your business. So get that and have your person.
There's no reason why you shouldn't have it.
You should have one. Have your CPA apply for an S corporation status as soon as possible. A lot of people are, David, I'll
mid-year. Can you do it when you just start taxes? Like when can you apply for the S corporation? If somebody hears us today, can they apply today to become an S corporation?
You need to do this as soon as possible. From the day your CPA faxes the S corporation election, which is the 2553 form, to the IRS, it takes between 2 and 3 months. For them to give you the status. You're going to get a letter from the IRS. Congratulations, Alexandra, you are considered an S corporation. Again, that's a privilege. It takes a couple of months for them to review your application and grant it to you. You need to do this as soon as possible. If you wait till next tax season to apply for an S corp, that's going to be effective for the month that you've applied. So open your LLC as soon as possible, apply for the S corporation as soon as possible. So at least half of this year, you'll be an S corp. The first half you'll be a Schedule C.
Can you be
tax debtor.
An S corp without an LLC?
You could be, yes, you could open a corporation, be an LLC. So see, the state of Nevada has 2 entities on its menu: LLC, limited liability company, and a corporation. Corporation's a bit more expensive. Corporation's, I believe, $825 or $850, and LLC is $450. It still limits your liability. It still becomes an S corporation. There's no, again, I'm not a lawyer, guys. Talk to a lawyer, understand the difference. But corporation, if you're a single person business, okay, LLC is suited to your needs just fine, in my opinion.
So when you were saying 450, this is what your annual dues are, guys. So yes, when you open an LLC and you open a corporation, you're going to pay your annual dues into the state of Nevada. And you open the LLCs and corporations on its state level.
Let's talk about something more important, in my opinion, that self-employed people need to plan for, which is one of the beauties of being not necessarily a corporation, but self-employed, is depreciation. Okay. Let's understand what depreciation is, Alexandra. I'm sure you know, but let's kind of unpack it. Let's kind of dissect it. So when you are a business owner, you make gross revenue, okay, $1 million, $10 million, whatever, and then we start deducting your expenses: power bill, internet bill, office, employees, taxes. All that those are expenses that are paid and gone. Okay, their majority of your expenses to maintain your business has been paid and gone. That expense is gone. But I have this conference room desk and it's still sitting here. The year's over, this desk is still here. I have this TV that's still here. Okay, so there's assets that I bought for my business, and years over, the power bill's gone, the internet's gone, and it's been paid for. But the assets are still sitting here. The assets, as far as the IRS is concerned, have a class life. The TV has a 5-year class life. This furniture has a, I want to say 7-year class life. Vehicles have a 5-year class life, which means this, according to the IRS, that they have a Clater table. According to them, this table will be useless, will be used up its value in 7 years. Okay, so you get to depreciate this asset. As far as the bank is concerned, depreciation is one of the expenses that's only on paper. You did not spend money depreciating this. So you may have a car depreciation of $5,000, $10,000. That reduces your taxes. You pay less taxes. But the bank understands that you did not pay that money out of your pocket. You still have the money. You retained it. So its depreciation is always added back to your income. That's the beauty of depreciation when you're applying for a mortgage, because that reduces your tax liability. And we both know that when clients are trying to buy a house, we need every dollar they can retain for down payment, for closing costs. We need to reduce their tax liability. So by increasing your depreciation, you can decrease
your tax. You can reduce your tax liability. At the same time, the higher depreciation that you took does not necessarily mean that at the time of the applying for a loan, your income is going to be considered as little as possible, because depreciation is going to go back into, it's an add back. So that is I think this is one of the most valuable pieces of information that everybody can carry home with them, but I'm pretty sure you've got more.
I do. Ask me if I have more. You did ask me. Okay, cool. So amortization. Amortization is not as popular. Amortization is your organization of your business. You open an LLC, you go to a lawyer, you have certain things. Let's say you buy a business, for all I care. Okay. There's some it's just like a depreciation, but it's not a tangible asset, so that gets amortized. So you're going to see a lot of amortization. Business startup costs to start a business are considered amortization, amortized over 15 years. That goes back as an add back as well. Office and home. If you're a realtor, you have one room in your office dedicated for, you don't have to be a realtor, but dedicated for business. Not, you also do pay bills or go on an MLS, but also your kids sleep there. But if you have a dedicated office, it must be a dedicated room to your business only, and your CPA deducts your expenses on your taxes for this room. Office and home expense is added back to your income as well.
And can I deduct partial bills like utility bills, because that room is going to use the AC and the power and the...
What they do is they ask you the square footage of your home and square footage of your room, and they determine what the square footage, the percentage is for that room, and they deduct only the expenses that pertain to your business. They're not going to deduct your, God knows, childcare or whatever, but internet, power, yes, security, they will. A percentage of the square footage of that house, of that room, that is only dedicated to your business. Again, I'm not a CPA, haven't done this in a while, but talk to your CPA. Have someone else other than me liable for their answer, but
check if your business is eligible to have a home office. And
another very cool way, office and home, is to reduce your tax liability on paper, but that's an automatic add back to your income. These are the things that my tax people do, explore, ask the right questions to clients. So we want to make sure that we legally reduce their tax liability, but we also give them as much income as possible so they can qualify for a mortgage with us.
Excellent. So far we got the depreciation, we got the amortization, and we got the home office expenses. What else you got, Brett?
we need to look at mileage. Realtors have a lot of mileage, for example. So, and if you're an Uber driver, you have a lot of mileage. Okay, that's in tens and tens of thousands of miles. And every mile, there's a standard mile deduction, or whatever that is this year, 57 cents or whatever. The standard mileage deduction is a combination of all your expenses. That would be oil change, tire change, gas, and your all that. I believe 23 or 25 cents out of your mileage is depreciation. So it's important to know how to extract depreciation, which is a small add back to your income. Every dollar matters from your mileage back to your income. We do that too. We have special tools for that.
So what do you do for those who drive electric vehicles? We don't have the oil change. We don't
Electric vehicles have something really cool. If you're the first owner, you get the 30, what was it, 75? I got 75 or $8,000 on my electrical vehicle back in 2016. But there is a credit towards your taxes, a tax credit, which is absolutely beautiful. Just the same energy credit with the same with solar panels. The electric vehicles get that too. IRS maintains a list of eligible vehicles, but it's so cool. You put in the VIN number and all of a sudden you got an $8,000 credit. Sometimes it lasts for a year or two. It's beautiful.
Sorry for putting you on the spot, but do you still remember the rule on the work trucks of 6,000 pounds and larger?
So the IRS, when it comes to depreciation, there's a special subchapter which is called Section 179 in the depreciation code for the revenue, the Internal Revenue Code, and that is if you have a work truck that is heavier than 6,000 pounds, it is eligible for Section 179, meaning you can deduct the full thing off your taxes, and which is why you see all of these trucks, SUVs, all the Cadillacs and all the Navigators and all, they're like 6,020 pounds or whatever. They're right slightly higher than 6,000 pounds, and they qualify, and you can take the full deduction from your taxes.
Absolutely.
Yeah.
So if you guys, if you're eligible to deduct a vehicle in your taxes, make sure that before you go vehicle shopping next time, you check with the dealer, you check online if the vehicle that you are looking to obtain actually going to cross this line of 6,000 pounds. And, if you're getting the new car anyways, why don't you write it off?
They'll tell you. The salesperson is aware. It's a selling point. They will make you aware.
Well, me, I do not, unless it comes to you, I do not leave it up to the people to tell me. I do my own research.
So one more thing.
As a professional.
I want to mention one more thing since, these videos are getting a lot of traction and people are watching this, Alexandra. I want to tell you about the one deduction on business taxes that usually hurts more than it should. I have to unpack it. I have to explain what it is. It's the meals deduction. It's the food. Okay. If I take a business partner, a realtor, a client out to lunch, okay, I'm only able to deduct 50% of that. My lunch is not deductible. It's not a business expense. It is my personal expense. My food is my personal expense. I can only deduct the portion of my client's food. Okay.
What if you took 4 clients out?
It's usually 50%.
Still 50%.
There are some exceptions. If you're in transportation employee, that goes 80%. Talk to your CPA. Again, I'm speaking as a loan officer here, but most underwriters don't go into your industry, and if your industry is allowed 80% or 100% deduction, they're going to automatically ding you for the other 50%. So if I see, which is line 24B in your taxes, line 24B on your Schedule C, meals and entertainment, if I see $1,000 deduction, this means that your actual expense was $2,000. And the tax software literally cuts it in half, only deducts 50% automatically. It's coded in the tax preparation software. So if the underwriter sees $1,000, for example, they're going to ding you for the other $1,000 that are not visible. They know it's only half of your actual expense. So be aware of this. Lots of people, I just saw this self-employed guy last week. He had like $47,000 of meals and whatever expenses. That was crazy. Untrue.
Wonder where he is.
Yeah. So, which means his actual expenses were 90 something thousand, right? Because it's only 50%. Imagine the underwriter's going to ding him for another 40 something thousand, whatever's on his taxes. The underwriter's going to ding him for the other 40 something thousand. It is a horrible expense. There are good expenses on your taxes. There's really bad expenses on your taxes. So
David, and before we end this live, I would like to ask you, can you give the general word of advice for those who are self-employed individuals as far as the tax preparation? How many years of tax returns are we looking at when the person is self-employed before we apply for a mortgage? And what would be the best practice of filing the tax returns for the self-employed individuals prior to applying for a mortgage?
So the general rule of thumb with mortgages is the magical number 2 years of residence history, 2 years of employment history. Okay, so if you've been self-employed, we're going to look at your 2 years of taxes, and we're going to average your net income, not gross, net income. We're going to add your 2021 line 31, add your 2022 line 31 into a one number divided by 24. We'll have your average income, which again, if you're a Schedule C, experience shows it's not that high. Now, you should become an S corporation, and you should, because it's just cheaper to show bigger taxes. There's the rule that if your business if you've been self-employed in the same line of work for more than 5 years, we can only show 1 year of taxes. So if you bring me your 5 years of taxes, bring it to your CPA, and your CPA will verify that you have been in the same line of work for 5 years. The CPA will give you a letter that says this person has been in the same line of work for 5 years. I have verified it. With that letter, you can only show 1 year of taxes. This is much cheaper on the person to buy when they want to buy a house, just because all we have to do is show 1 year of taxes instead of 2. This process is simpler when you have a corporation, because the corporation has the incorporation date on the top right corner, and there's no letter from the CPA. All you got to do is take a look at that date. When was it incorporated? More than 5 years ago. Never close corporations, guys. Let your corporations age. The older your corporations, the better for you. Much better for you.
Would you recommend all the self-employed individuals to consult with if there's any indication that they might be interested in getting a mortgage or getting a large loan out, to consult a loan officer before filing their taxes?
One thing I tell my clients throughout the year, that if they don't qualify, if income's not enough, whatever the reason is, I'll tell them, guys, will you please come talk to me before the tax season? Come talk to me in end of December, early January. Let's plan out your income before you file your taxes so you can qualify for that mortgage. Because most people in January, all you're thinking about is your refund. You're going to go get a nice refund for your earned income credit and all that, and all of a sudden you don't qualify. Come September, you were thinking about buying a house, you send your taxes to the loan officer. Loan officer's like, excuse me, you haven't shown enough taxes. My suggestion, my urge is, if you have any remote plans of buying a house in that given year, see a loan officer before you go get your taxes done. Understand how much income you need to show. What if you need to take a bigger deduction on your depreciation, for example? And to sort of, you can do certain elections in your taxes. So talk to your CPA, tell them, my loan officer said if I want to buy a $600,000 house, I need to have an X amount of income. What do we need to do? Can I show more depreciation? Maybe you need to go buy an asset in December. Come talk to me in December. Let's plan out. Maybe go buy an airplane like Grant Cardone did on December 25, and depreciate the whole thing.
So, do I hear you correctly that the best time to plan is now? It doesn't really matter. We're
Always.
In the beginning of May right now, so thank God all of the tax people have more time to devote to us. So right now it is the perfect timing to actually go ahead and ask them for the time to address all of your questions, all of your concerns. It is the greatest time to go and talk to the loan officer, guys. Talking to the loan officer does not cost you anything. Loan officers do not charge you for the information they provide. They don't.
I wish we
charge
could.
for their, yeah. It would be nice if you could charge for your
could.
time and education that you provide, but we're grateful that you do it for free, and we get the messages from the grateful clients every day. Like I just got another one 2 days ago saying that if it wouldn't be for David and his team, the credit score of my clients would still be under 700. And it is a happy family that is going to make a big move from East Coast to West Coast, and they're ready and happy, and that's thanks to you and your team, because people didn't know how to work with their credit, how to keep it up.
The team will be issuing their pre-approval today, but I guess what I would tell your viewers that are home buyers or realtors, I did notice a couple of realtors, is have your clients meet with a loan officer as soon as possible. I will either tell you, in some rare cases, this is not very frequent, you're good, you're golden, there's nothing I need to teach you. It does happen. Someone with 820 credit score and awesome income, seasoned assets, I could give you a pre-approval in 10 minutes. You're good, you're golden. There's nothing I need to, but Alexandra, the truth is, most of the time, everybody needs to prepare to an extent. So I'm going to give you a to-do list, whether it's a to-do list of 5 items or 10 items. I did give a to-do list to your client a couple of months ago, and he did it. And he's so grateful for that because his credit went up. He's got his green card. His income is proper in line. So talk to a loan officer. I am not allowed to charge you for my consultation. I wish I did. I would stick an invoice to you guys every single time you left my office. I cannot charge you. So come talk to me. It's free. Get your homework roadmap of what to do to prepare yourself. And so whenever the time comes, whenever you feel that you're ready, okay, you feel you want to buy next year, buy next year. But the next year may come and you may not qualify. So get prepared today.
There is nothing wrong in being ready at any time of the day, and there is everything right about the fact that you should know how to handle your financials. And being self-employed, it is overwhelming. It is hard. Like you start to, like you have to orchestrate this whole thing. You have to orchestrate the work, the company, the marketing, especially when we just start out. So it is extremely important when you put a great foundation to your financials, to your accounting, when you know what you're doing, working with professionals, and that will help you be ready at any time of the day. We're here to help you understand how to run your, how to treat, not run, but how to treat your credit, how to treat your financials, and David and his team are always ready to work with hand in hand with your CPAs, with your tax preparers, to make sure that you are taking the most benefit of everything that you do as far as your business, of all of the expenses that you can possibly file on your tax return that are not going to hurt you when you're applying for a loan.
Yay.
Is that correct?
Yes, ma'am. It is.
And if you guys are in the middle of the mortgage application right now, before you make any significant financial move, and we keep on telling that, guys, when we are in the middle of the mortgage application, we're not changing jobs, we're not switching correct jobs, we're not quitting jobs, we're doing our best not to get fired, and we're definitely not obtaining any new loan, any new debt.
Do not take time off to look for homes. Do not take a vacation, like unpaid time off to look for homes, just to feel that you're doing justice to that process, okay? Do not drop your income, please.
No. We'll do our best to accommodate your time and concerns. Like, we'll We'll show you properties at 8 o'clock in the morning. We'll show you properties at 6 p.m. We're in the summertime, like we can look at homes all the way till 8 p.m. and still be in the daytime. But please, 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 when you guys are in the process of obtaining a loan, do not make any financial decisions, anything that will affect your income without consulting your loan officer. Do not take any huge deduction. Do not file your taxes at a zero income because you're fed up with paying the government. You might not like the government at some point of time, but it doesn't matter. You will be liking your own house if you get the mortgage. David, any more pointers for us for today?
No, we talked about S corporation, the importance and the privilege of having an S corporation. We talked about depreciation. We talked about amortization. We talked about office and home. Those are all pluses. The meals deduction is, you got to be careful with that. Don't overdo it. Just deduct whatever the actual number was. A lot of people overdo it. I know it. It's the reality. And I guess we need to talk about, this was a conversation for self-employed people. We stuck to what you should do, Alexandra. But I guess we should also mention that there is a whole another industry out there, types of loans for self-employed people, where if you don't show the taxes, if you don't have verifiable income, then you can still get a house with slightly higher down payment. If you don't have the income, then assets need to be, the down payment needs to be slightly compensating for that. But with 10, 15, 20% down, you can get a house with only your bank statements. So you don't necessarily need a proper tax return to qualify for a mortgage. There are bank products that will finance you a house with your bank statements, because even some of these banks understand that people don't show their true income on taxes. So that's not what I recommend. These are expensive mortgages. That's not for everyone, but it is out there. So yes, do the right thing, get your S corporation, educate yourself to an extent. Every self-employed person, especially realtors, in my opinion, need to have a certain education about their own finances so they can consult their clients as well. But at the end of the day, if you have a client that needs to buy a house but does not have the proper taxes, there are bank statement loans, there are DSCR loans, there are even there's a no-doc loan. There's loans. Call us, we'll talk. There's loans.
So for those folks who are self-employed, but they either wrote off their income to zero or to like a negligent amount, a small amount, but those who have not filed their taxes for a while, there is still plenty of products that, yes, in case you desire to get a property right away, you can still qualify. There are products that David and his team are working with that will allow you to actually get a mortgage.
So if we go back to the CIA, the credit income assets, if your income is non-existent, if you cannot verify your income, then you better compensate with these two, with the credit and assets, down payment. You're not going to get a no tax return loan with 3% down or 5% down. That's not happening. I have a product with 10% down, but that's ugly. It's got like 10% interest rate. So you don't want that. But if you do have something decent, 20, 25% down, you can very well get a mortgage. But basically we can compensate for you not having income with higher down payment and decent credit score.
Excellent. So I'm glad to hear that you got all of our clients covered, whether they filed their taxes or did not file their taxes, whether they took great care of their financials when they became self-employed, or they're just stepping onto this road. And we're grateful that you and your team are very open and very upfront with this information, and thank you for being able to explain it in 3 different languages as far as I know. I know that your team would explain it in Russian and Armenian if it needs to be done. For those folks who are just entering the country or immigrating at this point and have the language barrier, I know you guys are there, and you're breaking down this process every day for our clients, and we're very grateful with that.
So as we finish our conversation today, I'm going to keep watching the Fed Reserve. Today's the 3rd, and he's going to announce another 0.25%. We're all expecting a 0.25% hike, and I'm guessing this is going to be the last rate hike for a long time. I think in June he'll say that he's going to stop. Okay, I'm going on record, predicting that he's going to stop in June. He'll probably hold on between 4 and 5 months. He will not raise rates, and I think we'll see slight rate easement in like September, October-ish, and we're going to have a frenzy. We're going to have so many people buy homes by the end of this year. You'll see.
And we're ready for it. We don't have the much inventory to buy. I am always giving the update on the inventory while you were joining the live. Yeah. So I was just starting this live with the fact that in the past 7 days, we had 715 properties to come on the market, and we have 982 properties going under the contract. So it tells you that we're absorbing faster than we are listing.
This is crazy. We're going to have a 2021, something crazier than that. We're going to auction on houses. We're going to have 20 offers on houses, I think, next year. Early next year, late this year.
Well, I will tell you that it is not September of 2022 anymore. It's getting tougher and tougher for us, the realtors, to negotiate the concessions and contributions towards the closing costs, whether we're dealing up. It is, folks, if you're thinking of buying a house, there is a very short period of time when you can still do it at a list price or close to list price, because very soon, I will not predict what the interest rates are going to be, but I will definitely tell you if we keep on absorbing more properties than we have the inventory, we're going to have a shortage. We're going to enter into the multiple offer situations once again. And Las Vegas, as one of the top 25 metropolitan areas, keeps on getting on this top 10 list of the most popular metropolitan areas where people move. And the Penske, the trucking company, the movers company, actually listed Las Vegas as the number 2 destination in the whole country where folks are moving. So make your choices. Welcome to Las Vegas, to those guys who are just relocated here, and as always, we're here happy to help you out with any information that we can. I'm always here to talk about the market. David is there to talk about the mortgages and your financial ability to get the house. Thank you, Ekaterina. And we're here to assist you. If you have any questions that are personal or have to do with your financials, please do reach out to us directly. Do not comment in the public comments, but if you have a general question, we're happy to respond to it. And before we actually go, I have to ask you the question that came in.
Please.
How can an 18-year-old who filed 2 tax returns get a mortgage? That was the question.
Yes, if the income is enough for debt to income ratio purposes, right? So we still have to see how much your debt is, how much your income is. But if we assume your income is enough, 18-year-old is just getting their credit report. I think you start establishing your credit at 18, so your credit has to be there as well. So assuming your C and income is good, you can. The only thing stopping you is going to be your 2-year employment history. And with FHA mortgages, we can consider your school, high school diploma, and your education as work history, as long as you got a job right after. You didn't have like a gap or anything. So theoretically, yes.
So if you're a parent of a 16-year-old who has a dream to own the house at 18, I would strongly recommend you grab your kid and you actually call David for a consultation and align everything for the next 2 years for your kids to be able to get that property when they're
I'm sorry.
18.
I'm going to tell you as a parent, if you have a 16-year-old, to send your kid to college. they'll get a chance to buy a house, get them an education. Sorry, that's gonna be my.
I
Obviously,
think that
that's my opinion,
I
but I'll still consider
well,
a
I would
mortgage.
say that I have to disagree with you on that. I don't think that college is for everybody and that it is a necessity. I would say that knowledge and ability to work, ability to create income is way more important right now
Agree.
than having a formal education. You know, like I would say education is important, but where you get it, it's up to you to decide whether you want to pay into and obtain a college debt if you want to, you know, or if you want to go and jump into some kind of profession that will generate you income before you, you know, like before you get the college debt. Unfortunately, I think that you would see a lot of people with the college debt on their credit that did not, you know, like, and with the diplomas that did not improve their income significantly. So
Fine. Send your teenager. I'll get him a mortgage.
you know
We're
what? I
joking.
would say that one day we can do the whole hour on the college debt and how it affects your credit ability. We can
I
do that,
can't talk an hour about that. Give me like 10 minutes.
but I think that the next session that we will try to do, if the technical gods are going to be on our side, and we will be able to do the screen share that we've been
Talking
trying so
about
hard
for
to.
3 months.
Yep.
Yeah.
But
I know.
we do have a financial tool that we wanted to share with our audience, and I'm super excited that we're that close to actually having the technical ability to do it, and to, you know, like, to share how the property ownership actually can change your life forever. And I'm super excited
Yes.
to have you talk about it.
That's really, truly valuable. I agree.
Thank you so much, David. Everybody have a wonderful week, and we see you next Wednesday live at 9:30. Otherwise, we will be talking to you in person. Thank
Thanks,
you.
Alexandra. Bye-bye.
Bye.